In this video, I want to highlight 10 defining features of penny stocks. It will serve as a very good guide to new investors. Penny stocks are low price, small cap stocks that typically trade outside the major market exchanges. Here are 10 key characteristics of penny stocks. Number one, low price per share. As the name implies, penny stocks, they have low price per share. Penny stocks usually trade at less than $5 per share and often even lower, sometimes for just a few cents. Although this particular feature is somewhat controversial, because in my home country, Nigeria, almost all the stocks in the exchange are selling for less than $5. So how do we justify this particular classification? All right, almost all of them, about 200 stocks in the market, in Nigerian Stock Exchange, they are actually selling at less than $5. Are they all penny stocks? No, not really. Number two, high volatility. The prices of penny stocks can fluctuate dramatically in a short period due to their low trading volume and speculative nature. For the fact that the price is low and the shares outstanding is equally low. So any large level of buy or sell mandates, once executed, will cause the price of the stock to fluctuate. It will fluctuate dramatically. And not only that, speculators, used to consider penny stocks a lot because the low volatility, or rather the high volatility, give them a kind of advantage when it comes to trading. Because it fluctuates so much, they feel they can make money when they trade penny stocks. That's a typical feature we need to take into consideration. Number three, low market capitalization. These stocks are generally from small companies with low market capitalization, often under $50 million. They are not highly capitalized. The entire share outstanding, by the time you multiply by the price, by the current price, usually it's not more than $50 million. So they are low market capitalization stocks or low cap stocks, kind of. Number four, illiquidity. Penny stocks often have low trading volume, making them less liquid. This can make it difficult to buy or sell large quantities without impacting the stock price because the share outstanding is kind of small, is sort of limited, not voluminous. So any little sales that involve a higher amount of funds will cause the stock to fluctuate. And not only that, generally you may not even find enough quantity to buy because there's no much outstanding shares available. And so this particular phenomenon leads to illiquidity. Sometimes the stocks will be very scarce to buy, if at all you can find them in larger quantity, because of the outstanding shares are generally very small, are generally limited compared to bigger companies in the market. Number five, over-the-counter trading. Many penny stocks trades on the over-the-counter market or pink sheets rather than on major exchanges like the New York Stock Exchange or NASDAQ due to the less stringent listing requirements. When it comes to listing requirements, these different exchange have different listing requirements. For the NASDAQ, it's a bit stringent. It's a bit, tough. For the NYSE, that's the New York Stock Exchange, it is somewhat a bit, tough equally. But for the over-the-counter markets, the listing requirement is somewhat low. It's not as strict as what's obtainable in the major exchange. So they tend to be traded, over the counter. Number six, lack of financial information. Companies that issue penny stocks often have limited financial disclosure and reporting, making it harder for investors to assess the company's health. They are not as transparent, so to say, as larger, bigger companies in the major exchanges. And so having information about them could be somewhat tedious. It may be difficult for you to be fully or highly informed about the activities or the financials of penny stocks. And so they lack adequate financial information. They hardly provide adequate financial information compared to bigger companies. Number seven rather, higher risk of fraud. Due to less regulation and oversight, penny stocks are more susceptible to market manipulation schemes like pump and dump. Pump and dump here simply means people will buy stocks, in bigger quantity as they are pumping money into the stock. The stock will be rising, rising, and rising. You get to a point they will just sell and recover their money out of the market. Then the price will plummet as a result of the sudden sales, in the share price, in the shares of the company. It is known as a pump and dump scheme. It's a kind of fraud that is perpetrated that is very peculiar to penny stocks. Number 8, speculative nature. These stocks are relatively speculative in nature. Penny stocks are often considered highly speculative investments with the potential for both substantial gains and significant losses. You can gain substantially. They can double, triple, quadruple in price, all things being equal, and they can equally go bust. So it's speculative when it comes to investing in penny stocks. These are factors one should really consider. They can grow wildly. They can equally drop almost like wildly. And so you stand to gain, you stand an opportunity of outsized gain, and also an opportunity of spectacular losses. Please subscribe to this channel and give me a thumbs up. It will do me a tons of good. Number 8, potentials for high return. Despite the risk, some penny stocks can yield high returns, particularly if the issuing company experiences rapid growth or acquisition. If the company issuing these penny stocks are acquired by a bigger company, it will cause the stock price to grow rapidly. Not only that, if they have a new technology, a new innovation, it can equally cause the stock price to grow significantly. So that higher potential returns is associated with penny stocks. Number 10, unstable or emerging companies. The companies behind penny stocks are often in early development stage or facing financial challenges, as the case may be, which can contribute to higher risk and potential reward. Generally, companies facing difficulties may slide into penny stock class, the class of penny stocks. Not only that, emerging companies, new companies in their early development, at the early developmental stage, can be classified as penny stocks. And so they are unstable. They are associated with emerging companies. They can appreciate rapidly and they can equally drop suddenly. So the risk is always there. As I told us earlier, it is highly speculative.